How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you the different types of annuities out there and why you might be interested in an annuity contract, and then try to distinguish, okay, which one might suit your needs better than others. Whenever you think of annuities, I want you to automatically assume income. Annuities were their primary purpose was designated for a income contract. Essentially, you're leveraging your dollars, whether that's in a 401k account, an IRA account, a cash account, and you want to eventually start taking money from these accounts. Well, rather than just going into one of those situations blindly and just kind of pulling out X amount of percentage that you're just playing a guessing game, or you're leaving it in the market and you're just living off the interest, there's a risk associated there. If you set it up the wrong way, you could essentially outlive your money, and you could outlive your money when you need it most, when you're in your 60s, 70s, 80s. And so what annuities do is they give you peace of mind. The very first type of annuity that I want to discuss is known as the immediate annuity. And with this sort of annuity, I want you to automatically think pension. It is designated just like a pension plan. You're placing money into an immediate annuity, and you're looking to turn on income within 30 days or within the year, and the insurance company is going to pay you an income stream that you can never outlive. In its most basic terms, you have different formats of the immediate annuity. You could have it on your life only, on yours and your spouse's life only, on a period certain for X amount of years. So there's different ways on how you could actually set up a strategy for the annuity, for the immediate annuities, and sort of do a laddering process, making sure that you have income coming to you and it is really correlating to your retirement income goals. So right when you hear immediate annuity, automatically assume pension. It's going to be income that you could never outlive. Now, then the next type of annuity is, think of this kind of like an account that's going to be gaining fixed interest. Think of this as kind of like a treasury bond. You have money that's in there, and you're not so much concerned on how much return you could get, but just mainly the safety. So with fixed annuities, they're just going to pay you a fixed percentage rate year by year. So if you had $200,000 in an account, and a typical treasury bond might be paying you 1%. Typically, the fixed annuities pay you about 2 to 3 times, sometimes 4 times higher than a typical treasury bond or a bank CD. So that's why individuals want to go more towards those fixed annuities. The major difference here is a fixed annuity is offered through an insurance company. A bank CD is offered through a bank. An insurance company cannot offer a bank CD. A bank cannot offer a fixed annuity. So they have just different reserve ratios there. But I want you to automatically assume fixed annuity is just like a bank CD or a treasury bond. Then you have the variable annuities, because individuals said, you know what, I understand the immediate annuity, but essentially I'm buying an income contract, but I don't have any of that old liquidity left there anymore. I have a max income that's coming to me, but I kind of lose a little bit control of my money. The fixed annuity used to be leveraged for retirement income planning, because individuals would be able to place their money in a fixed annuity, have just like that $200,000 example, for a 5-year fixed annuity, and have them pay upwards of 10%. So they'd be able to just live off the interest year by year and utilize that interest for income. That was in the 80s, the 90s. Well, unfortunately, times have changed, and interest rates are so low right now that you cannot utilize that strategy for retirement income planning anymore. So individuals said, okay, well, the fixed annuity, because it's tied to interest rates, and so are the treasury bonds and the bank CDs, well, what's there another sort of annuity that I could try to gain more money, have a better rate of return on my money? And that's where the variable annuity came out. I do not like variable annuities because there's a lot of hidden fees. I believe that if you're going to go into, if you're going to deal with mutual funds, that you deal with them directly. You don't deal with it within a variable annuity, because it's tied to the mutual fund, and if the mutual fund goes up, you will have gains in your account. If the mutual fund goes down, you will have losses in your account. But on top of it, because the typical fees that are associated with variable annuities are so high, if you ever have a downward market loss, it's basically a 4-tiered disaster of reverse dollar cost averaging. And please look up that term. And it's essentially mutual fund fees, advisor fees, the variable annuity fees, downward market loss, and also if you're taking money from these accounts, that could be just a whole culmination of bad things that could liquidate your accounts very, very fast. So with these three sorts of annuities, individuals say, okay, well, where's there a way that I could kind of participate with upward market movements, but not tied to the fixed rates that are paying such low rates of return? And that's where the index annuities came out. And essentially what it allows you to do is have your account participate with upward market movements without participating in downward market loss. And the way that the companies do this is you get to participate in, it mimics a stock market index, but you do not get to keep all the gains. So there's certain criteria, and each company is going to be different, but there's a certain criteria that allows you to, if the market gained 12%, you might be capped at 10% gains. But individuals want to go into this because you're going to beat the you could hedge that inflation risk that is there for the fixed accounts, and also not have any of not participate in any downward market losses. Meaning that if one year the index grows 10%, you could have a gain of that 10%. The next year, if that index loses 30%, you're just not going to gain anything. So it mimics the gains that are credited, kind of the computation that's credited to your account is based upon a market index. So I really hope that makes sense. And then you have the fifth type of annuity, which took a blend of the index, the fixed, and the immediate annuities. And this is something that I really, really love. It came out, it's more recent. It came out after 2008. And after that last market crash, and essentially what it does is it allows individuals that do not have pension plans to participate in upward market growth without the downward market loss, just like the index, have safe reserve ratios just like a fixed type of annuity, and have a income stream that you could turn on either immediately or at a later date in time that correlates specifically to your income goal. So an example of this would be, let's say if somebody's age 50 and they have an old 401k, or they have an old IRA, or they have a cash account, and they say, okay, well, I know that this money is going to be designated for retirement income, but I want to make sure that my account is going to be going up with the market, flatlining whenever the market goes down, so I never have actual loss to this account value, and also have a secondary guarantee, a secondary computation that is set up specifically for income. So it's really, really fascinating type products with the hybrid annuity. Once again, my name is Derek Afasi. Please give our 1-800 number a call at any time, because these annuities, they sound very attractive, but we are an independent agency and we leverage a lot of proprietary strategies, making sure that you're going to have the best quality company at the best possible rate for your specific situation. So if you give us a call and you say, okay, well, what's exactly this index annuity? I kind of understand it, but we're going to educate you first and foremost. And we're going to make sure, I understand you're interested in the index annuity. Was that the route that you wanted to go? And ask you a slew of questions. And then on top of it, try to figure out what would be the best possible situation. How can you leverage the best possible annuity contract out there for peace of mind in retirement? My favorite is the hybrid, but all these other ones serve their purpose. Other than the variable, I do not like the variable, and I've really spoken badly about them in previous times as well. It's just because of the risk factor there. I do not like the risk. I like that peace of mind. Hybrid annuities are excellent. If you guys could look at that section, look at some of my videos there. I mean, you could definitely learn a lot there. But please just leverage the company. In early April of 2014, we implemented 24/7 customer service, so you can give us a call anytime. It could be Sunday, it could be Saturday, it could be, obviously at any time that you want to speak with a specialist, we'll be standing by. So, all right, guys, thank you very much, and hope you enjoyed.